So Tesla is perhaps my biggest investment. Uh, well, definitely my biggest investment. I invested in them back in 2017 or 2018 before the price really took off. Um, and I've sold a little since then for certain purchases in life, but I've kept most of it. And I haven't really bought any shares since then until recently. Um, I'll go ahead and pull up their current stock price just to kind of give you a reference of how things have gone over the years here. So we'll pull up a 5 year. So back here, 2017, if it'll show me, yeah, right in here at 20. I think I was at $24 a share, uh, post split, and you can see here in 2020 the price started to take off, and then here we are today at 2028. Um, but the reason why I've started to buy more lately is because the price is quite low over the past year. Uh, Still up quite a bit over the past 5 years, of course, but over the past year and year to date, the stock is down quite a bit, and the PE ratio is still very high, a 70. And I always say here that a PE ratio of 15 is about what you want, but the PE ratio is looking back over the past 12 months. So this is called a trailing PE ratio. And you can also look at the next 12 months to come, and that'll be your forward PE ratio. And their forward PE ratio is about a 34, still pretty high, but whenever you start to extrapolate out to 2024 and 2025, the PE ratio starts to come down significantly and falls in the 20 no it falls in the 15 to 20 PE ratio range that we like to see. So in order to buy such a company, same deal for like an Apple or a Google or an Amazon, the idea is you would need to buy and hold it over the next 4 or 5 years to see any significant gain on your investment, or that's also called a growth stock. So this would be a growth play. And the reason why right now, I mean, yes, the stock price is pretty low over the past year or so, but another reason why I think it's a good idea for me anyway is that despite the economic outlook, Tesla keeps going 100%. They don't have any plans of slowing down, and they're speeding up and expanding. And you can look at some of their rivals, GM, Ford, Volkswagen. As we see these economic downturns, you see their companies uh, put pauses on their hiring. Maybe they cut some jobs and they start to disrupt their supply chain. We're not going to accept uh, 1,000,000 pounds of steel as we were going to. We're going to put that on pause. And so for the suppliers, they start to feel the same economic crunch, and they start to look elsewhere. Who can I sell this to? I have all this inventory. I need to get rid of it. It's going to look bad on my balance sheet. So Tesla, they, arms wide open, accepting all the material they can. Sometimes if their rivals are pulling back, they can get a better deal, but they can also build long-term relationships with suppliers and not run into uh, material crunches as other companies do. In 2020, that was a pretty big story. Um, None of the other vehicle companies could obtain chips, and so the prices of new cars, prices of used cars were actually up year over year. So you could have bought a 2012 Honda Civic and the year prior and actually made money on the car in 2020 and 2021. And that's just because everybody was scared during the coronavirus. Everybody started shutting down production, laying people off, and halting their supply lines because they thought that there was some backlash from it. Um, there were economic hiccups, but Tesla, they kept plowing ahead. They didn't close anything other than forced closures, and that put them in a really good spot. They didn't really run into any chip shortages, nothing that they couldn't work out and substitute in anyway. And part of that reason is because they didn't close anything down. They didn't call off any supplies or deliveries. So their suppliers stuck around. They even gained new suppliers. And here we see a similar situation in 2022 where everybody is nervous about a potential recession, starting to pump the brakes, and Tesla is still full throttle. So let's go over their investor deck. So what I'm doing, I'm going to Tesla. I'm clicking on, what am I clicking on? I typed it in. Let's get the menu up. Let's go to investor relations here at the bottom. So I'm going to investor relations, and then I am going to, if we download shareholder deck. I'm clicking that. That's going to bring you here to the shareholder deck or the PowerPoint presentation. Same thing. So this is Q3 2022 update. All right, we're just going to run through it, kind of give you a feel for where the company is. The operating cash flow of 3.3 billion in Q3. So it's a $2.2 billion increase in Q3 to 21.1 billion. Profitability, GAAP operating income. Let's see net income. Yeah, 3.3 net income. Yep. 27.9% GAAP automotive gross margin. That gross margin for competitors like Ford, GM would probably be something like a 10 to 15%. And their net margin is going to be something like a 2, maybe 5%. They had record energy storage deployments of 2.1 gigawatt hours. And so we're talking about Canadian Solar and some of the other videos, Jinko Solar. They're deploying just about the same amount of storage as these solar companies. And so that part of the business kind of gets left out of all the calculations. It still is factored into the PE ratio, their solar and energy department, AI, everything like that, full self-driving. So, but they are, and they're increasing quite a bit the amount of energy storage that they're deploying. And also they are eligible for benefits in the Inflation Reduction Act as well, supplying batteries to America. So and here we can see all of their numbers for this quarter in red compared to last year, this far one, all the quarters in between. So a lot of numbers here. Let's just run down the year-over-year percent change. This will help us get a pretty good perspective on how things are looking. Automotive revenue up 55% year-over-year. And if we were to look at their competitors, everybody's actually negative revenue year-over-year. They're selling less cars. Gross profit is up 42% year-over-year. The gross margin is actually down 2.6%. Total revenues, those are up 56%. Similar situation here. Operating expenses. So despite growing revenues 55%, their operating expenses are only up 2%. That's pretty crazy because usually companies, their operating expenses and their revenues, they trend very hand in hand. The increases in revenues is offset by the increase in operating expenses, and so their net income ends up being, relatively flat or very, very small despite a large revenue gain. So that's pretty impressive to see that they're only growing operating expenses 2%, and they actually just built two huge factories, one in Austin, Gigafactory Austin and Gigafactory Berlin. So despite building those out and despite trying to ramp those and making improvements in their Shanghai factory, they are only seeing 2% operating expense increase. They also started working on their Optimus robot, automated robot to help out in factories, and they're also about to start releasing the Tesla semi truck in December to Pepsi. Um, what else are they doing? They're starting production lines on their 4680 battery cell, next generation battery cell that charges faster, more capacity, less materials, easier to cool and heat, and still operating expense growth is only 2%. Income from operations, 84%. No, it's an increase. Income from operations, that's an increase of 84%. Wow, okay. So, adjusted EBITDA is up 55% year over year. Net income attributable to common stockholders, GAAP, that's up 103%. So net income doubled year over year. And non-GAAP, up 75%. EPS attributable to common stockholders, GAAP, this is going to be the, general accounting, something else, principles, forget the other A. This is up 98%, just about 100% year over year. Non-GAAP is up 70%. So, despite the 2% operating expense increase, EPS is up 100% year over year. And net cash up 62%. So, free cash flow was up 150%, and their cash equivalents is up 31% to $21.1 billion. And what's their operating expense? $1.7 billion per quarter is what they're going to spend on operating expenses. And they have $21.1 billion in the bank. So that's probably like 17 or 18 quarters, which is something like 4 years worth of operation. If they had zero revenue for the next 4 years, they still wouldn't run out of cash. And if they were going full speed, just piling cars up. So that's a crazy amount of cash that they're sitting on. We saw that. Increased average sale price year over year. And the average sale price actually declined quarter over quarter. In the prior quarter, average sales price was driven by limited Shanghai production. I see. Okay. Let's see. All right. Scrolling down, here's their production by platform. So, Model S and X, that was up 123% year over year. That is a pretty big deal because that's their most expensive models. Their Model S X, if you're buying that, you're spending $100,000, $90,000 at least, and up to like $130,000. So those being up 123%, that definitely helps. That was production, keep in mind. That's production, what they're making. And then Model 3 and Y, their cheaper variations, those were still up 51%. So, and then here's the total production, which was up 54%. And they alluded to 50% growth year over year for the foreseeable future. Here's their deliveries. This is what actually gets delivered to the customer. This is how they get paid. So this is what analysts like to look at. So S and X deliveries up 100%. Model 3 and Y deliveries up 40%. And this is why the stock plummeted so much, is because they did say prior to this quarter that they foresee 50% growth year over year for the foreseeable future. So they met that with production, did not meet that with deliveries. Now, the reason that management gave for this not meeting the delivery demand, but the delivery guidance, I guess, is because they were what the company had done prior to this quarter is at the end of the quarter, they pull people from their solar department, from their battery departments, uh, and everybody, it's all hands on deck. Get the cars out as quickly as possible. Get them loaded on cars. Get them out to the customer. We need the customer to receive the car, accept delivery, and give us payment before the last day of the quarter. That way we can say we sold as many cars as possible. And instead of pulling out all the stops to make this happen, this is the first quarter where they kind of were more relaxed about it. They're like, no, let's not disrupt the rest of the company. Let everything, go on as normal. And if we miss, we miss. No big deal. And so, and also they're changing up their regional sales. So how they would do it prior to this quarter, they would sell everything. Like if they're making cars in China or Fremont in California, they're gonna those first cars that they make in the beginning of the quarter, they're gonna ship out to Europe, different parts of Asia, Australia, New Zealand, and the reason is that those cars take the longest to get to the customers. So we're gonna ship those out first, and then the second part of the quarter, all of these cars are gonna be delivered here. We're gonna address the China demand. Now we're gonna address the California, United States demand, and so they're kind of shifting up how they're doing it. So that caused disruptions, and they said all of the cars that they produced are sold and accounted for, but that took place technically after the quarter was over. So this discrepancy here between the 51 cars produced and the 40% delivered, that will be reflected in the beginning of next quarter. Now, if they don't have a rush, mad dash, and deliver everything that they made beginning of this quarter that we're currently in, maybe we see a discrepancy again. But that kind of corrects itself over time. It's more healthy for the company not to pull people off what they're doing all the time, disrupting the flow of business. Leasing cars was down 34%. So here is their global vehicle inventory, days of supply. They have 8 days of supply. So that's up 33% from a year ago, but still not too much inventory that they are holding on to at the end of the quarter there. Solar deployed, it's up 13% year over year, but it's down sequentially. And then the storage deployed, this is the big beat here, up 62% year over year, sequential beat, and they're going to end up closing 22 out with quite a bit of storage delivered. 2, 3, 4 gigawatt hours, no, 4 megawatt hours. I'm sorry, this would actually be 4 gigawatt hours deployed so far in the quarter, with Q4 yet to come. They could end up getting to 6, maybe 7 gigawatt hours this year alone, which that's already way better than Canadian Solar and Jinko Solar. Let's see, store and service locations. Those were up 16% year over year. Mobile service fleet, that was up 29% year over year. Supercharger stations and connectors, both up 33%. So keeping up with making sure that their customers have somewhere to charge. Vehicle capacity. Here is their capacity. So just about 2 million cars that they can produce already in 2022. And this is expected to gear up significantly next year as Shanghai reaches full production capacity, California reaches full production capacity, same with Berlin and Texas. Maybe not next year, maybe the following year, but they will severely ramp up. And then Cybertruck, it is in the tooling phase, so they will be producing that pretty soon. They are guiding for June of next year, although there have been promised dates in the past, so it's promising to see tooling on here, though. That is definitely a sign that we're moving in the right direction. Tesla Semi out of Nevada, that is in early production, so that was past the tooling phase. And as I said before, they are planning to make first deliveries to Pepsi in the beginning of December. And then they're still developing the Roadster, the Robotaxi, which would be a $25,000 to $30,000 car. That would be the serviceable market, lower income. This is competing with like Honda Civic, Toyota Corolla, those type of cars. So Robotaxi and others would be like probably the Optimus robot. Any other undisclosed projects? Who knows? Still in development. In the semi truck, people were anticipating that the new 4680 battery cells would be going into the semi. They made the semi with 2190 cells, so they're not using those more battery dense cells in the semi yet. They have started putting them in the Texas Model Ys though, and so far no issues. They probably want to do a little bit more testing as far as that goes. And so here we go. The total number of 4680 cells produced increased 3x sequentially in Q3. The initial phase of Tesla semi deliveries is scheduled to begin in December 2022. Yep, there we go. What else? Let's see. So full self-driving is still being developed, and this is why they say that they're so confident that full self-driving period will be available relatively soon, is because of the cumulative miles driven. They're going to release full self-driving beta to all of North America beginning of next year, I believe. And you can see the millions of miles that have been driven on FSD beta. It's a parabolic chart because this is cumulative. And the more data that they can receive from cars on the road, the better FSD can be, as they have more data to wade through. And they actually have this Dojo training computer that trains their AI basically, that runs full self-driving beta. Eventually will run the Optimus robot. Instead of having to receive all these images and videos from cars on the road driving on full self-driving beta, what they did is they reworked their computer to sort and incorporate, put the right programming, coding and everything into the images and videos to tell the Dojo computer, this is what you're seeing, this is what you should do, this is what the human disengaged you and told you to do instead because you weren't doing it correctly. And so you have millions of images of the same interaction and all of these notes that you're telling the computer over time, like, hey, don't do that at a stop sign, you have to stop here before this line. If the line's not there, you stop at the sign, stuff like that. And if look left, right, whatever. And they've actually trained the computer to go in there, and now the computer is tagging the images in the video instead of programmers, engineers having to go in there and do it. And then what they do is they kind of sit back, watch the computer, and whenever the computer makes a mistake, they're like, no, here's how you should have tagged this one. And now they're training the computer to analyze all of the images and videos. So they're taking another step back. And so as more miles are driven, they think that makes the program more and more concrete and more likely to do the correct thing, take the right action. Let's see. Here's their energy storage deployment visualized here. I think, yeah, that's pretty much it. It's kind of the reason why. Yeah, here's a good chart to kind of summarize on. Here's their vehicle deliveries here on the far left, their cash flow and free cash flow here in the middle. Okay, it's the highest performing quarter in terms of free cash flow and total cash in the bank. And then their net income and adjusted EBITDA. And this quarter only rivaled by fourth quarter last year. So the stock sold off pretty heavy after this earnings came out, and it was only because of that delivery miss that we saw, the discrepancy between the amount of cars produced and the amount of cars delivered. And so everything looks okay at the business. They seem to be on track. I don't see any signs of slowing or heavy retraction in their financials. And so the stock selling off as much as it did, the future PE ratio being as low as it is, and the record amount of cash on hand, and this is their trailing 12 months charts. You can see vehicle deliveries, and so that's going to be a parabolic chart as it's cumulative over the last 12 months. Same deal here with their cash flow and their net income. What I am looking for is their debt. I am looking for their debt. Yeah, here we go. Let's see. Debt, finance leases, net of current proportion. Here we go. This line. Yep. $2 billion. Total debt excluding vehicle energy product financing. $63 million. Yeah, so not really any debt. $63 million debt compared to their $21.1 billion in the bank. There's really no risk. That's the thing. There's just no risk, and the company is doing great. Expected to continue doing great. Tons of cash. And it seems like what analysts are looking at as a negative, the delivery miss, is actually a long-term positive, as they don't have to pull employees around the company as much, disrupt the flow of things, and they don't have to rush, pay exorbitant transportation costs at the end of quarter. They can just relax and kind of let things handle themselves, let the process, trust the process, and let, when you deliver the vehicle, you deliver it. Like, why would you rush just to make sure the financials look good to keep analysts, Wall Street investors happy? I don't really get it. So, I've been buying here. 207 or so is like the average of my recent buys. Even here at 228 pre-split, that's 640, 60, 670 or so, 680, which is still pretty low considering we got up to 1300 at one point from the all-time high, which would be somewhere around 400 a share. But company's looking great. Net income's looking great. Cash flow, cash on hand looking good. No debt. Growth ahead. And they're just going to continue full steam ahead. And they're even going to, like in 2020, whenever their competition started scaling back due to the scares of the coronavirus, they were unsure of how their demand was going to look during that time. When Tesla kept plowing through full steam ahead, they benefited, picked up more suppliers, and they looked really reliable during that time. Now we have the same kind of situation with recession scares, people pulling back. If Tesla keeps steady, which I believe they will, then they're going to benefit from that as well. Pick up additional suppliers, look consistent, reliable again, and I just don't see any risk here. So that's why I'm buying. Not telling anyone to do that because currently they are still pretty expensive, 70 PE ratio, despite being a growth stock. But they have to perform perfectly to reach that 30 PE ratio next year, perfectly to reach a 15 forward PE ratio for 2024. But I think once the headwinds of all the recession fears, everything kind of clears up, this is definitely a winner. So that's just my analysis of this, and thanks for watching.